All right then, welcome back everyone to 5 Homes to Freedom. We are now module number 2. So I hope you enjoyed module number 1, lessons 1 through 6. Today what we're going to do is we're going to start off with lesson 1. Module 2 is quite large. There's actually 11 different lessons throughout the course. And the primary focus of module 2 is to understand the money, using partners or joint venture partners, and then looking at the numbers to determine whether it is a good deal or not. So we'll start off here in lesson 1 talking about sources of money. Okay, so sources of money are just, and again we're talking high level here, not just for the single family homes, but just sources of lenders out there. There's the banks that most everybody is familiar with. Then there's the mortgage brokers, and surprisingly less than 40% of people who borrow money actually know or even understand the use of a mortgage broker. So that's another source. Now they do not actually provide the money. They are the broker between the lenders, the many different lenders, and you, the person borrowing the money. Then there's the vendor finance, or what we call VTB. And then there's private money that's out there. Registered retirement savings, we'll talk about that. And then LOCs, your lines of credit. So we'll talk about the banks first. And in the U.S. market, the top 4 banks today, and I jokingly say today because the banking industry in the U.S. market is very, I was going to say volatile. It might be a little bit volatile, but it's more fluid. There's a lot of banks merging, taking over, etc. So currently, as I'm talking right now, the top 4 banks are JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo. In the Canadian market, the banking industry is considerably more stable, and the top 5 banks, which have been dominant for over 100 years, are Canada Trust, the Royal Bank, CIBC, Scotiabank, and the Bank of Montreal. So these are the main banking institutions in both countries that most people would go to if they were thinking of borrowing money from a bank. Next then, we have the mortgage brokers. And I said, as I mentioned briefly earlier, mortgage brokers do not have the cash to lend out like the banks do. What they are a broker between you, the borrower, and the many different lenders that are out there. And when I say many, I mean there are many. There's hundreds of different lenders out there. You can see on the right-hand side there a little snapshot of a lot of the different lenders that are out there. A lot of those are in the U.S. market. But these different lenders may include the banks that I just mentioned in the 2 previous slides. So it could be even the same bank that you currently bank with, that the mortgage broker may decide that that's the place to go and borrow the money for your particular deal because they just think it's a good fit. And more often than not, they'll get a better rate than you would as the client of that bank itself. And the mortgage brokers get such good rates because of the volume of the deals that they bring to the banks. So that's why banks work with mortgage brokers. And there's lots of private banks that are out there as well, more so in the U.S. market. Trust companies, which are like banks, are another big lender. Insurance companies are a huge lender. A lot of people don't even realize that insurance companies are in the business of lending mortgages. Then you've got your MIX, which is a mortgage investment company. And what that is a private group of individuals that will take will create a large pool of money for a group of investors, private investors, and they'll manage that money and they'll lend it out through mortgages to private lenders for different opportunities as well. Then there's private individuals, family members, friends, co-workers, etc. These are all different sources of money. So with respect to private, what you're looking at is a person using their own personal cash or their own personal line of credit. And this would be using other people's cash or lines of credit as well. So you can use your own cash, your own line of credit, or your cash and other people's lines of credit. And this could be from family, friends, co-workers, etc. And the neat thing about this is that there's a possibility for infinite return. And the ROI is an infinite number for your investor. And a lot of people won't understand, A, how that can work. And a lot of people don't even understand what infinite actually means. So here we have the symbol for infinite. If you ever see that out there, that's what this means, is that it's an infinite return on your investment. So let's just give you an example of what that actually looks like. So let's say that you have a friend and your friend borrows $100,000 at 4% interest through a secured line of credit. And that secured line of credit means that the money they're borrowing is secured by their asset, their house or another piece of property they may own. And because it's secured like that, they get a low interest rate of 4%. So then your friend turns around and lends you that same $100,000 to you, but at a higher interest rate of, say, 8%. Well, that 8% to you is still a very good interest rate because you can turn around and put that into an investment vehicle that's going to earn you 10, 15, 20% or more. So you're excited to get that money at the 8%. Now, on an annual basis, your friend has to pay out $4,000 interest every year to the bank that they borrowed that money from. But they're collecting from you $8,000 in interest because you're paying them 8%. That leaves them with $4,000 profit. Now that $4,000 profit on a $100,000 investment equals a 4% return on their investment. That's what most people believe, and that's what when they do the calculation, you take $4,000, you divide it by your $100,000 investment, that translates into a 4% ROI. Well, let's take a look at this. Is where the infinite return comes in. So here's the example: 4,000 divided by 100,000. You have to multiply it by 100 in order to convert it into a percentage format, which translate into 4% interest. Now, what happens though when you realize that that $100,000 isn't your $100,000? So we're talking about the friend here, the friend who lent you the money. They borrowed that money at $4,000 per year, and they're making an additional $4,000 per year. So whose money actually is it? It's not their money, it's the bank's money, and the bank is making their $4,000 on it, so it's no cost to your friend. So your friend is actually lending you somebody else's money. So your friend is making $4,000 with no money of theirs, $0. You do the math, that works out to, actually when you do the math on your calculator, you're going to get it's going to show up as an error because it can't compute, and that's your infinite return. So that's a pretty cool way of educating your friends and convincing them to lend money to you, because they can make easy money doing nothing. The money is secured against an investment property that you're buying, and they're making money off of the bank's money doing absolutely nothing, getting a phenomenal return. Another source of money is what we call a VTB, or it's a vendor take-back, seller financing. And these vendor take-backs are going to be held in the form of a mortgage, a legal mortgage, and it can be in first place, second place, third. It's also going to have structured so that it has conventional principal and interest payments, or it could be interest-only payments, or it can be a combination of the two. There's a great variety of different ways you can structure it. One vendor take-back mortgage that I negotiated on the purchase of a property was the property was in really rough shape, and it wasn't worth what the seller was wanting to sell it to me for. I didn't pay him what he wanted, but we did agree on a price, and then part of the deal was that he would finance through a vendor take-back mortgage 100% of the deal, and that was going to be for a 5-year term, amortized over 25 years, so the life of the mortgage was 25 years. And he would honor that mortgage at 9% interest for 5 years, and the first 6 months was interest-free, no payments. So for the first 6 months, I didn't have to make any payments on the mortgage. There was no interest being charged. That allowed me time to go in and fix up the property and get it set for a conventional financing, so I didn't even have to use the vendor take back at all. So there's a variety of different ways of structuring a vendor take back, and it's definitely easier when you can talk directly to the seller and create a relationship with the seller to do that. Now, some of the pros of doing a vendor take back for the seller, they're usually able to get closer to what they feel the property is actually worth, get more for it. The seller will also make more interest if they finance that property, because in a lot of cases, if it's an investment property, then you can ask the investor or the seller, what are you going to do with the money when you're done? In many cases, they're just looking to retire, so they're going to put the money in the bank and maybe into a guaranteed investment or something, some low interest bearing account at 1 or 2%. And if you can give them 6, 7, or 8% secured against a property they're already familiar with, quite often that's appealing to them and it helps them make more money. It also helps them sell a difficult property. My example earlier was a perfect example where nobody in their right mind was going to pay him the price for that property, and no lender was going to lend anywhere close to what that property would have sold for based on its condition. Because he did the VTB and we negotiated and came to terms, I was able to take that headache away from him and make it a win-win for both of us. And this is another big one also. When a person sells an investment property, there's capital gains involved. And in the U.S. market, the capital gains can be deferred if you reinvest that money within 6 months into another investment opportunity of equal or greater value. In Canada, there is no exemption for capital gains, so you can't get around it. But what you can do in both countries is you can help defer the capital gains over a period of 5 years. So the benefit to doing this is that that total capital gain that is taxable income can be split into 5 parts and added to your taxable income a little bit less each year, therefore keeping you potentially in a lower tax bracket. From a buyer's perspective, you do not need to qualify for a conventional mortgage because you're dealing directly with the seller. Now, the seller may or may not ask for some more information like a credit check. In my case, they didn't ask for anything. The buyer can also structure deals very creatively and finance the property much earlier. And that's a pretty advanced strategy for a creative finance, and that's more like what I was talking about in the deal where I had the 6-month free interest. I was able to refinance that property and get money back out of it. Some of the cons for the seller, they may not get all of the cash out of the deal or as much of the cash out of the deal immediately, and they're going to have to stay connected with that property. So they can't just wash their hands of it and be done with it. Because if they're holding a mortgage, it's going to be connected to that property. They're receiving monthly payments. And if for whatever reason the buyer defaults on the mortgage payments, the seller could end up with that property back in their possession, which they may or may not want. And from a buyer's perspective, you're usually paying higher interest rates as well. Another great source of funding is retirement funds. This is one that many people do not understand. Now, a lot of people know that they can tap into their own retirement funds to help come up with the down payment for when they buy their own personal property. That's not what I'm talking about here. What I'm talking about here is creating actual mortgages from your retirement funds, whether they be the RRSPs in Canada or the 401ks, IRA funds in the US market. You can create first, second, and third mortgages at arm's length, which means that non-family members. And much like the VTBs, you can negotiate directly with the person lending the money as to whether you pay principal and interest, interest only, or some combination thereof. And you're usually able to borrow up to 90% of the value of the property that you are borrowing against. In some cases, depends on the rules, they keep changing. In some rare cases, you can go up to 100%. The non-arm's length, meaning that you're dealing with family members, direct family members, they will only allow you to create mortgages if they're in first place and also insured. And from that perspective, as an investor, that just doesn't make sense. So you want to be dealing with arm's length mortgages. And to do this, you just create the person who's lending the money has to put it into a self-directed fund that will allow you to create these RSP mortgages. If you want to learn more information about this, in Canada, you can visit spirepoint.ca for more details. And Paul Blackyer owns SpirePoint. He actually has a course that you can invest in to learn how to do this properly. For my American students, I'm currently researching more details on this, but the website that I have posted here is a great starting spot for you to take a look at. Alright, so that's it for Lesson 1. Again, hold off on your questions until we finish the complete module. And if your questions are not answered by that point in time, then attend the live webinar where we will quickly review the entire Module 2, and then we'll open it up to live questions. If you're unable to attend the live recording, then send your questions in ahead of time. And if your questions are still not answered after that, then please feel free to email me at ken@5homestofreedom.com anytime. Thanks very much, and we'll see you in the next lesson.